Hi, everyone. Welcome to your latest Carson's Glass Half Full. Sonu, what a difference a couple months make. Yeah, but a couple weeks make as well from what we've been seeing. The big question we're asking ourselves is why are stocks back to new highs? I think I said that right.
And there you go.
How in
Both
the
of
world?
us are like smiling,
Yeah,
like much more
you know,
than maybe we have over the
you
last month, 6 weeks.
like it is just incredible. The time we're recording this, the S&P 500 is, back at new highs. We've had a wild ride. We're going to get more into the economy and different things. But why did we bounce back so fast, you think?
A couple of things. One is it looks like the ceasefire is holding, right?
Okay.
Talks are good. On the face of it, it looks like every party in this has come to, dare I say, the conclusion that there's no military solution to reopening the Strait of Hormuz. We won't get into how important that is. We've spent any number of weeks talking about that. But it has to be a diplomatic solution. They have to talk with each other. I think they'll get to a deal. Now, it may take a long time. Deals are not done within 1 day or 1 week or even
Sure.
2 weeks, but the path is there. I think that's why, markets are sort of like looking forward to the end of this crisis. And then the short answer to why is the S&P 500 once again at an all-time high? Profits are going up.
Yeah, so I'll chime in a little bit. We can dig into more of the profit stuff there in a second. When you look at like major geopolitical events, like the ones where American soldiers, are involved, right? World War I, World War II, we're talking Vietnam, big ones. If you look at history, Sonu, the stock market tends to bottom very early, like in the top 10 to 15% of the time frame of the entire conflict. So the market bottoms early, and then you can continue to go higher. And I know with the headlines and all the uncertainty and the volatility in oil markets, volatility in commodity markets, a lot of unease that's out there. But we talked when this all started, we looked at 42 major geopolitical events. The market was lower 1 month later. Check mark that. We were lower 1 month after this conflict started. But then 3 months later, out to a year later, if the economy stays strong, like you're probably going to lay out here as soon as I'm done talking why the economy's hanging in there, you tend to get through it. And this time doesn't look too much different. Last comment, Sonu, than to you. We've said before that this was not going to be the first year in history without a bunch of volatility and without bad headlines. We've been spoiled. 2023 right now, we were talking about the regional bank crisis. 2024 in August, we had the yen carry trade unwind and everything was falling apart. Last year, we had a darn near bear market, 10% drop in 2 days after Liberation Day. And now this year, what's happening is happening. But those last 3 years, 25% gain, 24% gain, 18% gain, okay, with those volatilities. So volatility is a toll we pay to invest. So I went a bunch of places with that. What do you want to add to this conversation?
Look, one thing interesting that's happened, and maybe it shouldn't be a big surprise. We'll talk about that. Over the last 6 weeks, I mean, of course, the crisis is a surprise, and we didn't predict it or anything. So that was a surprise, to be clear. Profit expectations, forward-looking profit expectations, have just gone, dare I say, vertical over these last 6 weeks. They just continue to move higher, which means, we throw out jargon like PE ratios and valuation. Essentially, it's a measure of how cheap are stocks. Look, if stocks have gone down, but earnings, profit expectations have gone up, that means from a valuation perspective, stocks have gotten cheaper.
Yeah.
Right? And if you think about it, like what drives stock prices, it's two things. It's corporate profits, expectations, and valuations, plus dividends. Set dividends aside for now. What's happened with corporate profits, as I just said, that's going up. Why is that going up? There are two pieces to corporate profits now. One is how fast are sales growing? Where do sales come from? Nominal GDP growth. That's nominal. Keep that in mind. It's not inflation adjusted, right? Usually when you get GDP growth data, it's actually a real GDP growth and it's inflation adjusted. But what matters for companies, what matters for revenues and profits, it's actually nominal GDP growth. Nominal GDP growth is probably running about 5 to 6% right now. That's a very good environment for sales growth. And then you think sales growth plus the other piece for profits is margin expansion. Now, here's where it gets a little controversial. We are all seeing inflation. We've seen inflation for the last several years. We're seeing a little more of it in the first quarter, energy prices, things like that. But the other side, yours and my inflation is somebody else's and other companies' margin expansion, right?
Yeah.
So when you think inflation, yes, I complain about inflation, but that means the company that I'm paying a price for, whether it's good or service, they're seeing their margins going up, and margins going up is good for stocks, right? I'm not saying don't complain about inflation here, but there's a reason why stocks are going up.
Well, no, great point. Great points across the board there. And I kind of sound like a broken record, but we've called these the dual tailwinds this bull market. Higher profit margins, higher corporate profits, both of those hitting new cycle highs, new all-time highs. It's hard not to think that the market, the stock market, will follow along. And that's exactly what we're seeing. One more kind of, I guess I'll call it fun one. The S&P 500, the recent 10-day strength that we had was Sonu up 9.8% in 10 days. 10 trading days. I mean, that's an incredible move. That's like in the 99.7 percentile of all 10 days out there. It's an extreme move. The recent times, so in recent history, we saw 10 days that strong, coming off of Liberation Day, coming off of COVID, January of 2019, and which for history buffs in the market, that was actually a really bullish time for the market. Big rally late in 2018, early 2019. And then two times in after the GFC in April of 2009 and July of 2009. I know I just said a lot. All I want everyone to know, those times I just mentioned were all extremely strong times for future stock returns after an extremely strong 10-day rally. My take, the market is smarter than any of us. The market doesn't care about our feelings. The market is telling us the lows have happened. The market is telling us it wants to go higher once again. Things can happen. That can be changed. That's why we keep a diversified portfolio. But the reality is this strength we've seen, Sonu, is not a short covering rally. It's not just some little bounce. This is a legit move that is historic with the market wants to go higher. So I'll let you bring us home in another minute or so. What do you want to say?
Look,
to wrap
it gets
this
back to a phrase you've used in the past, a slingshot.
Yeah.
You get a slingshot, and then you get momentum. Now you're in an all-time new high, assuming it closes there today as we record. We're recording this several hours before the market closes, but let's say the S&P 500 is close to a new high at 7,000. That's huge. One market high begets another market high. Just because you hit a new all-time high doesn't mean you have to suddenly go down. Momentum begets momentum. And you have several tailwinds. We've been talking about the fact that the labor market is stronger than it is.
Yeah.
It means income growth is stronger. That means consumer spending is relatively okay, right? Investment is booming on the AI side because of the AI build out. We are going to be talking a lot. We're going to once again talk more about AI, right?
Yes.
And then as inflation picks up, look, the Fed is talking about holding rates steady. Normally, when inflation picks up, you worry about the Fed increasing interest rates. That would be a headwind to equities, but we're not talking about that. I don't think the Fed is going to raise rates. Which means what? As inflation picks up, the Fed is holding pat. That is a dovish scenario. That's positive for equities too. So we have, and then, one last thing, Ryan, before we close off, companies are starting to get tariff refunds. Guess what that does to profit margins? Now the administration in July and August may come back and say, oh, we're reimposing tariffs. They're using some other authorities. But for now, companies are going to start getting tariff refunds. That's another tailwind.
Well, that's some good stuff there. We covered a lot in the latest Class F full. The reality is, thank you for watching these. We understand the last couple of months have been anything but easy from a investor's point of view, but that's why we invest for the long run. And the good news is we've come back, and we never said this bull market was over. Volatility happens, but we still think this bull market's alive and well. And everyone, thank you so much for listening to the latest Class F full. Why is the stock market back to new highs? Because there's a lot of reasons it should be, and we don't think it's over. So see everybody next week. Take care. Thank you.